In 1912, the average American kept every dollar he earned, all of it. No W-2, no April 15th, no withholding. The federal government ran on tariffs, land sales, and excise taxes on whiskey and tobacco. Your paycheck was yours. Then the 16th Amendment passed in 1913, and the income tax became permanent. But for over a century before that, Americans had already figured out how to build wealth, move money, protect assets, and retire comfortably without a single tax code to work around. Some of these tricks were brilliant, some were borderline criminal. Number 6 on this list created more American fortunes than the California gold rush. And number 1 was so effective that Congress had to write specific laws to shut it down. These are 20 money moves from an America that ran without the IRS. Subscribe, because this stuff did not make it into your history textbook for a reason. If you have ever wondered how Americans built generational wealth before the government took a cut, you are in the right place. Hit subscribe so you do not miss what comes next. Drop a like if you are ready, and tell us in the comments which of these tricks you would have used if you had been alive back then. Now let us get into it. Number 20, paying in whiskey. Before 1862, the federal government had no income tax, but it also had a shaky currency. Paper money changed value depending on which bank printed it and how far you stood from that bank's front door. So Americans did what made sense. They paid each other in whiskey. Barrel-aged corn whiskey held its value better than most banknotes. Farmers in Appalachia and western Pennsylvania used jugs of it to pay the doctor, the blacksmith, the preacher. A gallon of decent whiskey in 1820 traded at roughly 25 cents, stable enough that some counties used it as their unofficial unit of account. George Washington ran one of the largest distilleries in Virginia after he left the presidency. He was producing 11,000 gallons a year by 1799. That operation cleared about $7,500 annually, more than most plantations earned from tobacco. When Alexander Hamilton tried to tax whiskey in 1791, farmers in western Pennsylvania grabbed their rifles. The Whiskey Rebellion was a tax revolt before tax revolts had a name. The government won, but the practice of trading in spirits never stopped. It just went quieter. Number 19, tontines. Your great-great-grandfather might have joined a tontine, and if he lived long enough, it made him rich. A tontine worked like this. A group of people, sometimes 30, sometimes 300, pooled money into a shared fund. The fund paid out dividends every year, split among surviving members. When a member died, his share got redistributed to whoever was still breathing. Last man standing collected everything. By 1905, nearly 2/3 of American households had money in a tontine. Over $7 billion sat in these pools, more than the total assets of the U.S. Treasury at the time. The incentive structure was obvious and uncomfortable. Your neighbor's funeral was your payday. Insurance regulators eventually banned most tontine arrangements by 1906 after a series of fraud scandals and at least a few suspiciously convenient deaths. But for 50 years, tontines were the single most popular financial product in the country, and most of the wealth they generated was never taxed because there was nothing to tax it with. Number 18, wildcat banking. Between 1837 and 1863, anyone with enough capital and a convincing-looking building could open a bank and print money, literally. State-chartered banks issued their own paper currency backed by whatever assets they claimed to hold. A bank in Michigan might print $50,000 in banknotes backed by a vault full of gold, or backed by nothing but a leather satchel and a fast horse headed for the state line. The term wildcat bank came from the practice of opening these operations in remote locations where wildcats outnumbered customers, making it nearly impossible for anyone to show up and demand their gold. The ones that lasted, though, made their founders enormously wealthy. A banker in Ohio who managed his reserves honestly and lent carefully could clear 12 to 18% annual returns with zero federal oversight, zero reserve requirements, and zero reporting. He set his own interest rates. He decided who got credit, and he paid no income tax on any of it. The National Banking Acts of 1863 and 1864 shut most of this down by taxing state banknotes out of existence. but the fortunes made during those 26 years of financial anarchy seeded family wealth that still exists in parts of the Midwest. Number 17. Homesteading free government land. The Homestead Act of 1862 handed 160 acres of federal land to anyone willing to live on it for 5 years and improve it. The filing fee was $18. That was the total cost of 160 acres, a quarter square mile, of American soil. By 1934, when the program wound down, the government had given away 270 million acres, 10% of all U.S. land, transferred to private citizens for almost nothing. Families who claimed homesteads in Kansas, Nebraska, and the Dakotas in the 1870s were sitting on farms worth tens of thousands of dollars by 1910. The wealth transfer was staggering and came with no tax consequence. You claimed your land, you worked it, you owned it. Nobody sent you a bill in April. The program excluded most Black Americans through a combination of literacy requirements, local administration, and outright violence. Native Americans lost ancestral territory to make the acreage available. The wealth the Homestead Act created was real. So were the people it was built on top of. Number 16. Private toll roads. Before the federal highway system, Americans who wanted roads built them and charged for the privilege of using them. Turnpike companies were among the most common investments of the early 1800s. Between 1792 and 1845, over 1,500 turnpike companies incorporated in the northeastern states alone. A group of businessmen in Connecticut would pool $10,000, build a graded road between two market towns, and set up a toll gate every few miles. Traffic paid by the axle. A farmer hauling grain to port paid 2 cents per mile. A stagecoach paid more. The returns were modest on most routes, 3 to 6% annually. But the real money came from owning property near the road. The men who built turnpikes also bought the land along them. When the road brought traffic, the land brought buyers. The toll revenue was the salary. The real estate was the fortune. None of it was taxed by the federal government because the federal government did not tax income, property, or capital gains. Number 15. Married women's property. Before 1839, a married woman in most states owned nothing. Her property, her earnings, her inheritance, all belonged legally to her husband. Then Mississippi passed the Married Women's Property Act, and other states followed through the 1850s and 1860s. Families figured out the angle almost immediately. A man facing creditors could transfer property into his wife's name. Since she was now a separate legal owner, his debts could not touch her assets. Bankruptcy wiped the husband clean. The family kept the farm. This was not a loophole. Entire legal practices were built around structuring family wealth to exploit the gap between husband and wife as separate property holders. Merchants, farmers, and speculators all used it. The assets sheltered this way generated income that, again, nobody in Washington was collecting a percentage of. Number 14. Gold hoarding. Americans did not trust banks, with good reason, given how many of them collapsed, so they buried their money. Gold coins went into tin boxes under floorboards, inside stone walls, and at the base of fence posts. This was standard practice, not eccentricity. During the panics of 1837, 1857, 1873, and 1893, families who kept gold outside the banking system watched their neighbors lose everything while their buried stash held its value. A $20 gold piece in 1850 bought the same basket of goods in 1900. 50 years of perfect purchasing power hidden in a coffee can. No bank could fail on you. No counterparty risk, no reporting. And when you spent it, nobody tracked the transaction. The IRS did not exist to care, and when it finally did, it had no mechanism to find gold buried in a field behind your barn. Franklin Roosevelt's Executive Order 6102 in 1933, which forced Americans to surrender their gold, was specifically designed to end this practice 40 years after the income tax began, because the government still could not get people to stop doing it. Number 13. Fraternal benefit societies. Citius, the Odd Fellows, the Knights of Pythias, the Woodmen of the World. These were not social clubs. They were privately run insurance companies wrapped in secret handshakes and matching hats. By 1900, fraternal benefit societies covered an estimated 30% of American adult males. Members paid monthly dues, usually $1 or $2, and in return received sickness benefits, disability payments, funeral expenses, and sometimes a lump sum death benefit paid to the family. The Ancient Order of United Workmen alone had 450,000 members by 1902 and had paid out over $100 million in death claims. These organizations operated outside government regulation for decades. No federal agency audited them. Their income, their payouts, their investment returns all existed in a space where the IRS had no jurisdiction because the IRS had no existence. When commercial insurance companies grew large enough to lobby state legislatures, fraternal societies got hit with regulations they could not afford to follow. Most collapsed by the 1930s. The families who had relied on them were funneled into commercial products with higher premiums and lower payouts. Number 12. Land flipping at the frontier. Speculators bought land at government auctions for $1.25 an acre, the federal minimum price, and sold it within months to arriving settlers for $5, $10, sometimes $20 an acre. The profit margin made modern real estate flipping look modest. During the 1830s land boom, entire towns were platted on paper, sold lot by lot to investors in New York and Philadelphia, and sometimes never built at all. Andrew Jackson was so alarmed by the speculation that he issued the Specie Circular in 1836, requiring payment for government land in gold or silver rather than paper bank notes. The speculators who timed it right, buying early, selling before the bust, accumulated fortunes that funded family dynasties for generations. Daniel Webster, a sitting U.S. Senator, was personally involved in Western land speculation. He was not an exception, he was the norm. No capital gains tax existed to slow the churn. Buy on Monday, sell on Friday, keep everything. Number 11. Apprenticeship bonds. Har samhetsståndsvärde. A master craftsman in 1840 took on an apprentice aged 12 or 13. The boy's father sometimes paid a bond, $50 to $200, for the privilege of placing his son. The master provided room, board, and training for 4 to 7 years. At the end, the apprentice left with a trade, a set of tools, and sometimes a small cash payment called freedom dues. The master, meanwhile, had received years of cheap labor and a cash bond up front. A silversmith in Philadelphia running 3 apprentices at once was collecting labor worth 10 times what he spent feeding and housing them. That surplus was income, untaxed, unregulated, unreported. Apprenticeship was the original employee stock plan. The apprentice invested his youth, the master invested his knowledge. Both walked away wealthier, and the government was not involved at any point in the transaction. Number 10. Cotton factoring. A cotton factor was a middleman who advanced money to a plantation owner before the harvest, sold the cotton at market, took a commission, and returned the balance. The factor was banker, broker, and commodity trader rolled into one person. Factors in New Orleans and Charleston controlled the flow of the South's most valuable export. Their commissions ran 2.5% on sales, plus interest on the cash advance, plus fees for storage, insurance, and shipping. A factor handling $500,000 in cotton annually cleared $30,000 to $50,000 in fees, a phenomenal income in the 1840s. The wealth these men accumulated was enormous and entirely outside any federal tax framework. Monsell White, a New Orleans factor, died in 1863 with an estate valued at over $1 million. He had never filed a tax return in his life because there was no tax return to file for most of the years he earned it. Number 9. Private coinage. A siege savouste your Christmasklape, your Jurger say the Thape. When the U.S. Mint could not produce enough coins to keep up with commerce, which happened constantly in the first half of the 1800s, private mints filled the gap. Companies and individuals struck their own gold and silver coins and put them into circulation. The Beckler family in North Carolina minted over $2.2 million in gold coins between 1831 and 1852. Their coins were so reliable that banks and merchants preferred them to federal issues. In California, after the gold rush, at least 15 private mints operated openly, stamping out $50 gold slugs and $20 pieces. The profit was in the spread. A private mint could buy raw gold at a discount, coin it at face value, and pocket the difference, a margin of 3 to 8% on every coin struck. No licensing fee, no federal oversight until 1864. No tax on the profits. When the government finally outlawed private coinage, the families running these operations had already converted their profits into land, buildings, and commercial enterprises that continued generating untaxed wealth for decades. Number 8. Warehouse receipts as currency. A tobacco farmer in Virginia stored his crop at a public warehouse and received a receipt stating the quantity and grade. That receipt circulated as money. It passed from hand to hand in transactions, each holder trusting that the tobacco behind it was still sitting in the warehouse. Virginia's colonial legislature actually designated tobacco warehouse receipts as legal tender in 1730. The system lasted into the early 1800s. A farmer who produced more tobacco than he needed to spend had, in effect, printed his own money. The surplus crop sat in storage, backing the paper, and the paper bought land, tools, livestock, and labor. The man who controlled the warehouse controlled the local money supply. Warehouse operators charged storage fees, graded the tobacco sometimes generously for friends, and earned a percentage on every transaction that flowed through their facility. The entire economy of Tidewater, Virginia ran on this system for over a century, and not a cent of federal tax touched it. Number 7. Packet ship investments. Before railroads dominated American transport, packet ships, vessels running scheduled routes between port cities, were the backbone of commerce. Investors bought shares in individual ships the way modern investors buy shares in a company. A 1/16th share in a New York to Liverpool packet in 1825 might cost $2,000. A successful crossing generated freight and passenger revenue that could return 15 to 30% annually. The risks were real: storms, piracy, mechanical failure, but the returns dwarfed anything a savings account offered. Cornelius Vanderbilt started with a single ferryboat and built a shipping empire worth $100 million by the time he died in 1877. He famously paid minimal taxes throughout his life because, for most of it, there were minimal taxes to pay. His fortune compounded for decades in a zero-income tax environment, and by the time the government gained the power to tax it, the wealth had been converted into railroads, real estate, and trusts that proved nearly impossible to touch. Number 6. Building and loan associations. 24 neighbors pooled their savings, $5 a month each, into a shared fund. When the pot grew large enough, one member received a loan to buy or build a home. The group kept contributing, and the next member got their loan the following year. Repeat until everyone had a house. The Oxford Provident Building Association, founded in Frankfort, Pennsylvania in 1831, was the first in the country. By 1890, over 5,600 building and loan associations operated across America, holding $450 million in assets. These were neighborhood banks without the bank. No federal charter, no outside investors demanding returns, no regulatory filings. The interest paid on deposits and charged on loans stayed inside the community. The wealth created, the homes themselves, passed to families free and clear, often within 10 to 15 years. A factory worker in Baltimore who joined a building and loan in 1870 owned his home outright by 1882. His mortgage payments had gone to his neighbors, not to a distant bank. His equity was real, and nobody in government had taken a cut of any transaction along the way. Building and loans created more homeowners per dollar invested than any federal program that followed them. Number 5. State-run lotteries. State-run lotteries funded Harvard, Yale, Princeton, Dartmouth, and Columbia. They built roads, bridges, and public buildings across the eastern seaboard, and they made individual winners very wealthy without any tax on the winnings. Between 1790 and 1860, American lotteries generated over $66 million for public works, more than the federal government spent on internal improvements during the same period. Tickets cost anywhere from 25 cents to $20, and top prizes could reach $100,000. The men who ran lottery operations were among the wealthiest in their states. Licensed lottery brokers, the 19th century equivalent of a brokerage firm, handled ticket sales, managed drawings, and collected commissions of 12 to 15%. A broker in New York or Philadelphia handling $500,000 in annual ticket sales, was clearing $60,000 to $75,000 with zero income tax liability. Scandals and fraud eventually turned public opinion against lotteries. By 1890, most states had banned them. The revenue stream vanished. Governments needed a replacement. The income tax adopted 23 years later was not a coincidence. Number 4. Merchant credit networks. One isto verixem receptits to via donorship if 20 cent for posit wuthores wishamis ting the workel rusums of will posit. Without a national banking system for most of the 1800s, merchants ran their own credit operations. A general store owner in rural Ohio extended credit to every farmer in the county. He kept a ledger with running balances. Farmers bought seed and supplies on credit in spring and paid their tab after harvest in autumn. The store owner charged no stated interest. Instead, he marked up goods sold on credit by 20 to 40% over cash price. A barrel of flour that cost $4 cash cost $5.50 on credit. That markup was the interest rate, and it was invisible to anyone who did not compare the two prices carefully. Large merchants ran credit networks spanning multiple counties. They bought goods wholesale, sold retail on credit, collected after harvest, and reinvested the profits, all without a bank, a loan officer, or a tax collector involved at any step. By the time a successful country merchant died, his estate often included the store, the building, several farms acquired through foreclosure on unpaid debts, and a ledger full of receivables that his sons inherited and continued collecting. The entire operation existed in a space the federal government could not see and did not regulate. Number 3. Trust funds. The original version. The modern trust fund gets associated with inherited wealth and prep school kids. The original version was a working tool used by merchants, farmers, and tradesmen to protect assets from creditors, distribute wealth to heirs, and avoid the costs of probate. A New England shipping merchant in 1830 could place his ships, warehouse, and commercial inventory into a trust administered by a trusted friend or lawyer. The trust owned the assets. The merchant controlled the trust. If the merchant's personal ventures failed, creditors could seize his personal property but could not touch the trust. The legal structure was straightforward. Transfer assets out of your own name and into a trust. The trust generates income. The income goes to beneficiaries, your wife, your children, your grandchildren, without passing through probate, without public disclosure, and without any federal agency asking for a percentage. Dynastic trusts set up in the 1800s, before any income or estate tax existed, compounded wealth across 3, 4, 5 generations. Some of them survived the introduction of income tax, estate tax, and generation-skipping transfer tax through grandfather clauses and careful legal management. A handful are still operating. Number 2. Tax-free municipal bonds. Before there was anything to be tax-free from, cities and states borrowed money by selling bonds to finance canals, railroads, water systems, and public buildings. The interest paid on those bonds was exempt from state taxation by tradition and later by law. When the federal income tax arrived in 1913, municipal bond interest was also exempted from federal tax, and it still is. Wealthy Americans in the late 1800s parked fortunes in municipal bonds yielding 5 to 7% annually. A family with $200,000 in municipal bonds in 1890, a large but not uncommon sum for a successful merchant, collected $10,000 to $14,000 per year in interest, free of every tax that existed or would exist for the next century. The exemption survived because every member of Congress represented a city or state that needed to borrow cheaply, and taxing the bonds would raise borrowing costs. The loophole was bipartisan, permanent, and enormously valuable. It remains one of the last surviving echoes of pre-IRS wealth strategy, still used by wealthy families for exactly the same reason it was used in 1870. Number 1. Dying without an estate tax. The single greatest wealth trick available to Americans before the IRS existed was dying. Specifically, dying rich and passing everything to your heirs tax-free. The federal estate tax did not exist until 1916. For 140 years, every dollar an American accumulated over a lifetime, in land, gold, ships, factories, bonds, or buried coffee cans, transferred to the next generation at full value. No 40% haircut, no filing, no team of estate lawyers. You died, your children inherited, and the only cost was the funeral. John Jacob Astor died in 1848 worth approximately $20 million, roughly $700 million in today's money. His heirs received every cent. Cornelius Vanderbilt's $100 million estate passed intact in 1877. The Rockefeller, Carnegie, and Morgan fortunes all compounded for decades before any estate tax touched them. The families who stacked wealth during this window did not just get rich, they built financial positions so large that even after the estate tax, the income tax, and a century of regulation, their descendants remain among the wealthiest Americans alive. Every generation since has played by tighter rules. The game board got smaller with each new tax code revision. But the families who built their stacks before the rules existed had a head start that in some cases has never been erased. That is the list. 20 ways Americans built, moved, protected, and passed along wealth in an era when the government took none of it. Some of these strategies were available to anyone with a strong back and $50. Others required the kind of capital that only came from already having capital, but they all shared one feature. The money stayed where the earner put it. When the IRS arrived, it did not invent taxation, it invented visibility. The government could suddenly see what people earned, what they owned, and what they passed along. The money tricks did not stop. They just got more expensive, more complicated, and more dependent on lawyers. Your great-grandparents did not have accountants. They had instincts, community, and a government that had not yet figured out how to watch. Drop a comment and tell us which of these you would have used. And if you are still here, you already think about money differently than most people. Subscribe so you catch the next one. If this countdown opened your eyes, hit that like button and subscribe so you do not miss the next one. Tap the bell for notifications. Share this with someone who thinks the tax code has always been around, because it has not. And the stories from before it existed are wilder than anything happening on Wall Street today. We will see you in the next one. That is the list. 20 ways Americans built, moved, protected, and passed along wealth in an era when the government took none of it. Some of these strategies were available to anyone with a strong back and $50. Others required the kind of capital that only came from already having capital, but they all shared one feature. The money stayed where the earner put it. When the IRS arrived, it did not invent taxation, it invented visibility. The government could suddenly see what people earned, what they owned, and what they passed along. The money tricks did not stop. They just got more expensive, more complicated, and more dependent on lawyers. Your great-grandparents did not have accountants. They had instincts, community, and a government that had not yet figured out how to watch. Drop a comment and tell us which of these you would have used. And if you are still here, you already think about money differently than most people. Subscribe so you catch the next one. If this countdown opened your eyes, hit that like button and subscribe so you do not miss the next one. Tap the bell for notifications. Share this with someone who thinks the tax code has always been around, because it has not. And the stories from before it existed are wilder than anything happening on Wall Street today. We will see you in the next one.